Let's discuss capital gains taxes, how they work, and when they affect your income. Capital gains taxes apply to some investment accounts and other financial vehicles. It's important to understand how these work, in which scenarios they apply, and which are exceptions from capital gains taxes. There are two types of capital gains taxes, short-term and long-term. Short-term capital gains are applied to assets held for 1 year or less. Long-term capital gains are applied to assets held longer than 1 year. Short-term capital gains taxes are the same as ordinary income tax rates, generally 10 to 37%. If you buy a stock for $100 and a few months later you sell it when it is $150, the $50 gain or profit is taxed at your usual income tax rate. Long-term capital gains taxes are lower but still depend on your income. The rates range from 0 to 20%. Single filers earning less than $48,350 annually pay no capital gains taxes. Single filers earning between $48,351 and $533,400 pay just 15%. Those earning over $533,400 pay 20%. The thresholds are higher for joint filers. These numbers are for 2025. Income thresholds increase over time to account for inflation. There may be situations or circumstances in which selling an asset held for a year or less and paying short-term capital gains taxes makes sense, but you probably see how playing the long game is generally to your advantage when it comes to holding investments and other assets. This underscores the importance of time in the market rather than attempting to time the market. Buy and hold is a good strategy. You may be wondering what is subject to capital gains taxes and what isn't. Capital gains taxes apply to investments. This may include investments held in a taxable brokerage account, investment real estate, and primary residences sold less than 2 years after purchase when there is a large profit, generally $250,000 or more for single filers. Some investment and other financial vehicles are not subject to capital gains taxes. Roth IRAs, Roth and pre-tax contributions to employer-sponsored accounts such as 401ks, 403bs, 457bs, 529 college savings plans, health savings accounts or HSAs, cash value gains, and permanent life insurance policies unless certain circumstances are met. What questions do you have about capital gains taxes? Comment below.